Hi friends, hope you're doing fine. Today I'm narrating a summary from the book Small Giants, written by Burlingham. In this book, the Small Giants veteran journalist Bo Burlingham introduces an alternative approach these companies have taken to stay powerful. By rejecting the pressure to grow revenue, they focus on other fulfilling business goals, including creating a great place to work, providing excellent customer service, or contributing to their local communities. From small giants, we can learn how to redefine the meaning of success and understand the benefits we can reap from staying true to our core values. Companies that choose to be great instead of big. When we talk about companies, we generally group them into three buckets: big, getting big, and small. However, in small giants, we get to discover that companies that do not fit in those traditional categories. Most of these companies are growing in unconventional ways. Several have chosen to stay stagnant, while others are actively shrinking their operations. Aside from that, these companies share a couple of characteristics. To begin with, they are utterly determined to be the best at what they do. They have all had the opportunity to raise a lot of capital, grow very fast, do mergers and acquisitions, expand geographically, and generally followed the well worn route of other successful companies. However, they have chosen to pursue other goals that they consider more important than getting as big as possible as fast as possible. Our media mainly focuses on the traditional big companies. For example, books like Good to Great and In Search of Excellence understandably focus on big public companies or the companies that have aspired to be big and go public. Because the data for those types of companies are made accessible. Because of this, we have missed a very viable path. Myth number one: business must grow or die. Most public companies need to show steadily increase in sales, profits, and market share and EBITDA to keep the shareholders happy. It's a common belief that investors would sell away with their shares in a company when they see any sign of decline or stagnancy. However, there are companies that are able to maintain their operation without significant growth. Myth number two: a business needs to be number one or number two in its niche. An idea that was promoted by former CEO of General Electric, Jack Welch. However, it is difficult to see how this rule is applicable for the vast majority of the companies that are neither large nor publicly owned. Myth number three: the concept of getting to the next level. When it comes to businesses, the phrase next level always implicates more sales and revenue. The idea is that you get to the next level when you can handle the managerial demands of operating a larger business, because the next level implies that bigger is better. However, this is not true for the majority of the companies and business owners. Myth number 4: confusion around stakeholders and shareholder value. For public companies, shareholder values refers to the price of the stock that represents the net present value of future cash, a flow of dividends. We assume that all business should operate this way. If they take an investment of time, money, or effort from someone, they get back what they want in return. But that assumption misses an obvious truth. What's in the interest of shareholder depends on who the shareholders are. Who's in charge here? Most business startups go through a roller coaster ride. Along the way, successful companies go through the full range of pressures that often cause the startups to lose control of their companies at an early stage. It's far more difficult to keep ownership and control inside a privately owned business as it grows. Unless you succeed in retaining control, you will wind up with the company driven not by your own aspirations, but rather by the need to meet growth targets set by external stakeholders. Forces you have to battle. Competitors. The pressure from big competitors or the fear of new competitors chasing you down can be more pressure to grow. If you become mildly successful, eventually someone else will catch on to what you are doing. If they want a slice of the action too, you will think that you need to grow in order to build that moat or to overturn them so that they can't catch you and corner you in your niche opportunity. Suppliers, they have vested interest in seeing your company grow. The more you sell, the more they sell to you as well. The psychological pressures. If there's an opportunity to gain more power and status for your company, you will be probably be tempted to take it. However, growth of your company will bring forth changes that you may not like it. It takes a lot of strength to stay stagnant or to actively choose to say no to the opportunities for growth. You need to be intentional about why you want to grow or not to grow, rather than being driven by your own ego. The idea that bigger is better has pervaded our culture so much that most people assume all entrepreneurs want to capitalize on every business opportunity and grow their companies as fast as they can. The widespread assumption becomes a big pressure to grow, especially when personal pride, status, and prestige are tied to the perceived size of the company. Growth in leaps. The other problem is that you can't really grow big businesses little by little. The giant leap means either having a big gap now between demand and supply or taking on a heap of new money. The same concept goes for human resources. You can't just get your team to work 2% or 3% harder to grow the company. You will need to hire a new full time employee, pay a decent salary, and spend 6 to 12 months training them. Forces to sell. Companies that can't finance their own growth are often forced to sell part of their company. That's how many people end up losing their company simply because people, when they become too successful. To be sure, many people don't lose their company, but they lose a lot other things instead. Taking on a debt means adding more pressure to grow in order to service the debt. And selling to other investors means you lose significant portion of your independence. As a result, it becomes much more difficult to make the choice that the small giants successful companies have made. It's not possible, or it's not impossible to find investors that will allow you to grow as you like, but there are always bargains or trade offs involved. External stakeholders must buy into your business vision, which will only happen if they have get what they want out of the business deal as well. The neglected path highlighted in Small Giants. Grow or die is a false dichotomy. You can actively choose to not to grow and still maintain a successful, profitable business. Bigger isn't always better because sometimes the gains you get from a bigger business are more than offset by the losses of independence. Companies mentioned in Small Giants have learned that achieving these goals often means detaching themselves from the external investors and avoiding rapid growth. They have also chosen to stay private and closely held and place other goals ahead of growth. In return, they get two important things: control and time. The combination of control plus time equals freedom, or more precisely, the opportunity for freedom. If you're interested to watch such inspirational and knowledgeable summaries which can transform your life, then hit the like button and subscribe to our channel for more updates.